Hello everyone, my name is Constanta Lungu and this is my Finance 551 Bloomberg based project. The aim of this project is to perform a 5-year time trend and peer group analysis of 2 chosen industries with 5 companies each using data from Bloomberg professional software and select the most attractive company to invest in based on the information considered. The industries picked for this project are oil and gas and pharmaceutical biotechnology, specifically the cannabis biotechnology. The oil and gas companies selected include ConocoPhillips, Chevron Corporation, Hess Corporation, Marathon Oil Corporation, and ExxonMobil Corporation. The companies selected from the pharmaceutical biotechnology industry include AbbVie Corporation, Cara Therapeutics, GW Pharmaceuticals, Insys Therapeutics, and Zynerba Pharmaceuticals. These companies exhibit a great focus on developing novelty drugs that use medical marijuana to treat human diseases. I will analyze first the oil and gas companies and start with the short-term solvency ratios, which include the current ratio, quick ratio, and the cash ratio. We can see that all companies had an increase in the current ratio over the last 5 years besides Chevron Corporation, and the most significant increase occurred for Marathon Oil Corporation from 0.60% in 2012 to 1.94% at the end of 2016. Quick ratio is the highest for Marathon Oil Corporation, followed by Hess Corporation, and cash ratio is the highest for Marathon Oil Corporation and Hess Corporation again. Looking at these liquidity ratios, we can see that Marathon Oil Corporation does best at meeting its short-term financial obligations, followed by Hess Corporation. Next, we move to long-term solvency ratios, which include total debt, debt equity, equity multiplier times interest earned, and cash coverage. Total debt ratio is the highest for ConocoPhillips, followed by Marathon Oil Corporation. The debt equity ratio seems to be increasing for ConocoPhillips, which is the highest right now at 78.69%, and followed by Marathon Oil Corporation. Then we look at the equity multiplier, and the highest equity multiplier is for ConocoPhillips at 2.58, and the lowest is for Marathon Oil Corporation. Times interest earned ratio is negative for ConocoPhillips, which means that the company cannot afford the debt, which is risky. But ExxonMobil seems to do well. The same is looking at the cash coverage. ExxonMobil does best at being able to afford its debt. Next, we look at the asset management and especially the total asset turnover. The highest total asset turnover is currently for ExxonMobil. Now we move to profitability and return on equity decomposition. We'll look first at the profit margin elements that include tax burden, interest burden, and EBIT margin. The tax burden, the higher it is, the less the company pays in tax. So we see that Exxon pays less in tax than all the other companies. Now we move to interest burden, and we see that all companies pay very little interest burden in interest. EBIT margin seems it is highest for ExxonMobil and is negative for all the other four companies, which will probably reflect on the profit margin. So we should expect Exxon to have a higher profit margin, and yes, Exxon has a 4.54% profit margin, while all the other companies have negative profit margin. Return on assets is highest for ExxonMobil, and return on equity is highest for ExxonMobil and is negative for all the other four companies. Next we move to market value measures, and we see that we look at the price earnings ratio. Chevron and Exxon have high price earning ratios, and this means that the market thinks highly of the future performance of the company, but the company can also be overvalued, and we'll see about that later. Market to book ratio is the highest for ExxonMobil, currently at 2.08%. The cost of capital is the lowest for ExxonMobil at 8.08%. We look at the EVA spread, and we see that all companies have negative EVA spread, which means that all companies are losing money at the moment for their shareholders. Next we move to enterprise value, which is the total value of the company, or the takeover price if the company would be sold, and we see that ExxonMobil has the highest enterprise value of $401 billion. Enterprise value multiple is the highest for Hess, and it's followed by ExxonMobil. Looking at the supply chain, the only thing that seemed suspicious was that Chevron supplies 80% of its products to only 2 companies out of 108, which is not very good. Next, I calculated the target price for the next 12 months. For ExxonMobil, my estimated price was 87.13. The dividend discount model said that the price should be 108.51, which means that the stock is currently undervalued. I also estimated the price for Chevron, and it should be $132.24, and the dividend discount model says that the price should be $50.54. So the stock is currently overvalued. I was unable to calculate the target price for ConocoPhillips Hess and Marathon Oil Corporation, since either had not enough information or just negative earnings per share. Analysts recommend buying ConocoPhillips and Chevron stock, while I personally would invest in ExxonMobil since it has the highest total asset turnover times interest, profit margin, EBIT margin, return on assets, return on equity, market to book ratio, enterprise value, and the stock is currently undervalued. On the second part of this project, I will start looking at how the companies in the pharmaceutical biotechnology are doing, and we'll start directly with the short-term solvency with the current ratio. We see the highest current ratio is for Cara, followed by Zynerba in the last 12 months. The quick ratio again is the highest for Cara Therapeutics and is followed by Zynerba. Cash ratio again is the highest for the Cara and Zynerba. Next we move to long-term solvency ratios. The highest total debt ratio is for a BV. The debt equity ratio is again very high for a BV incorporation. Equity multiplier is so the financial leverage is the highest for a BV as well. Let's but looking at the times interest earned ratio, we see that a BV can afford it's dead, while some other companies like GW Pharmaceuticals cannot. And the same is true when it comes to cash coverage ratio. And we move to asset management, and we'll look at total asset turnover. We see that BV has the highest total asset turnover from all the 5 companies. We'll start with the tax burden from the profitability and ROE decomposition, and to see what drives the increase in the profit margin. So all companies seems to pay not too much in taxes, as it's all the percentages are close to 100. Looking at the interest burden, again we see that companies are not paying too much in interest. EBIT margin is only positive for a BV, which should have its effects on the profit margin. And yes, profit margin is the highest for a BV incorporation, followed by INSEE, while for the other 3 companies is negative. Return on assets is positive for a BV, and the highest return on asset is for INSEE. Looking at return on equity, we see that a BV is the winner. It has the highest return, and it's followed by INSEE. Now we look at the market value measures, and we notice that INSEE has higher price earning than a BV, but they might be again overvalued, or it might be just a measure of the market thinking positively of the future performance of the company. Now we look at the market to book ratios, and a BV seems to have the highest market to book ratio. The cost of capital is the lowest for a BV incorporation for the last 12 months is 7.26%. And next we look at the EVA spread, and we see that BV has the highest EVA spread, and it's followed by INSEE with 10.42%. And this means that these companies actually make money for their shareholders, while the other 3 are not. Enterprise value is the highest for a BV incorporation. It's valued at $120 billion. The enterprise value multiple is high for both a BV and INSEE, although we don't have too much information on this slide. So I looked at other additional Bloomberg information, and on the supply chain, BV and INSEE take about 50% of their revenue from 2 companies, and it's too much exposure for only 2 companies. Next, I calculated the target price for the next 12 months. BV has an estimated price of $69.5. The current price is $55.89, and the dividend discount model says that the price should be $108.65, which means the stock is undervalued. INSEE's estimated price is $14.62. Current price is $11.99, and dividend discount model is $34.58, which means that looking at the dividend discount model, the stock is currently undervalued. For GW Pharmaceuticals, Zynerba and Cara, I was unable to find the target price because they had expected negative future earnings per share. Analysts recommend to buy stock in Cara, GWP, INSEE, Zynerba, but my personal opinion is that I should invest in a BV because it has the highest EBIT margin, times interest ratio, cash ratio, market to book ratio, EVA spread, enterprise value, and the stock is currently undervalued. So overall, the pharmaceutical biotechnology industry is more attractive than the oil and gas industry in terms of investing. The pharmaceutical industry has relatively better short-term solvency measures, lower use of debt, and more use of equity, which leads to smaller cost of capital, higher EBIT margin, ROE, EVA spread, and my company pick between ExxonMobil and a BV incorporation would be a BV incorporation. A BV shares recorded 10.53% year-to-date gains in 2016, and I think it's a good stock option for investors who are looking for diversified exposure to medical marijuana stock. Thank you.